Okay, so I want you to just picture a financial scenario for a second, one that's so bizarre, it uh, it almost seems to violate basic math.
Right.
You have a publicly traded company, but its total market value is actually less than the physical cash it has sitting in the bank.
It's the ultimate market anomaly. It really is. It's a puzzle where the answer seems obvious, but the path to it is, well, it's just paved with risk.
We are diving deep into the very strange case of INO Holdings, ticker INHD, and this is all based on a really fascinating analysis report you provided us. The core mystery we're tackling is, it's pretty simple. How can a stock trade at what's called a negative enterprise value?
And our mission here is to figure that out for you.
Exactly.
Yeah.
Is INHD the opportunity of a lifetime, that hidden gem everyone else missed? Or is this just a dire warning sign? The ultimate value trap waiting to spring?
It's a huge question.
Okay, let's unpack this. Before we get into all the anxiety around this company, we really have to establish the basic math that creates this whole situation.
Right. And when we talk about negative enterprise value, we're really talking about a fundamental imbalance in how the market perceives a company.
So enterprise value is supposed to be the true cost of buying a company, right?
Exactly. You take the market cap, you add all the debt, and then you subtract the cash.
Simple enough. So if I buy a company for $100 million, but it has $20 million in cash and $5 million in debt, the real cost, the enterprise value, is $85 million.
Precisely. Now, here's the twist. If the amount of cash a company holds is actually greater than its market cap and its debt combined, that calculation flips. It goes negative.
And what does that signal?
It suggests the market believes the company's future is so toxic, its expenses are so high, that they completely negate every single dollar of real, tangible cash on the books right now.
And with INO Holdings, the numbers are, well, they're kind of astonishing. Let's look at the latest filings that create this anomaly.
So based on those filings, INO Holdings has approximately $10.3 million in cold, hard cash.
10 million. That number is the core of their tangible asset floor.
It should be.
But now, contrast that with its market cap, which has been hovering dramatically lower. We're talking somewhere between, 4.7 and 5.6 million.
Yeah, there's about a $5 million gap there between the company's perceived worth and the actual money it has.
The implication of that is it's profound.
It is. Mathematically, if a savvy buyer, let's say an activist hedge fund, wanted to acquire the entire company today,
Go on.
they'd be paying about $5 million to get a bank account that holds $10 million. It sounds like a free lunch.
So if the math is that clear, why hasn't someone already stepped in to arbitrage this? Why isn't this stock just screaming higher based on that cash value alone?
And that is the central tension of this whole story. That mathematical discrepancy, it establishes a really powerful theoretical floor for the stock price.
But there's a catch.
A massive one. The entire thesis, that whole acquisition scenario, it all assumes that the $10 million in cash isn't just, vanishing.
And the market is telling us, with this super low valuation, that it profoundly distrusts management's ability to hold on to that cash.
Exactly. And that brings us right to the bear case. If we connect this to the bigger picture, the real question isn't, can the company survive, but more, why is the market ignoring $10 million?
And the answer seems to be the speed at which that cash is leaving the building.
The fear is entirely existential, and it's all driven by one thing, the cash burn rate. When you look at their quarterly financials, the company shows an operating loss of about $860,000 per quarter.
Which on its own suggests they can survive for a couple of years, right?
It does. But the analysis report points out that the more critical number, the free cash flow metric, is far, far worse. It showed a loss closer to negative $4.7 million in some periods.
Oh, why is there such a massive gap between the operating loss and the actual cash flow?
That gap is what absolutely terrifies sophisticated investors. The operating loss, that just measures daily business revenue minus costs. But free cash flow, FCF, that's the true picture of the cash hole.
So that negative 4.7 million, that includes things like heavy capital expenditures, stuff that isn't in the day-to-day loss number.
Yes, exactly. It's the truer measure of the drain on the bank account.
So the market isn't just worried about the daily losses. It's terrified of this deep hole the company's digging every single quarter.
A hole that's 4 or 5 times worse than the operating loss suggests. And that kind of velocity, that just shrinks the survival window dramatically.
So that $10 million.
Based on the FCF burn, the fear is that the 10 million cash pile disappears within maybe a narrow 12 to 18-month window. And if the cash is gone,
the theoretical floor is gone with it. The stock goes to zero.
And the fear is compounded by recent corporate actions that signal distress, not strength. I'm talking about that recent 1-for-24 reverse split.
Yeah, that is not the action of a thriving company.
Not at all. That split, back in December, it was a defensive Hail Mary play. purely to satisfy NASDAQ listing requirements because the share price had fallen too low. It was an artificial lift.
And historically, we know these splits often just create more selling pressure.
Right. Long-term investors who were trapped suddenly see a higher price, and they use it as their chance to finally get out, flooding the market with shares.
It's a vicious cycle. And then you add in the biggest unknown of all, sector uncertainty. The company is trying to pull off this massive strategic shift right now.
A massive shift.
Wait, a shift from proprietary steel technology, which sounds, capital intensive, hard to get into, to electronics trading primarily in Hong Kong. That sounds less like a pivot and more like throwing darts at a map. Doesn't that just add another layer of risk, regardless of the cash?
It absolutely increases the skepticism. The bull thesis, which we'll get to, argues the old instruction model was a guaranteed way to burn cash. The new focus, electronics trading, is supposed to be asset-light, quick turn, and faster at generating revenue, even if the margins are slim.
So the market is basically saying, we don't trust you with the cash, we've seen the reverse split, and we are extremely skeptical you can pull off this random pivot.
That's it. That's what explains the $5 million gap. It's fear completely outweighing the objective asset value.
But there have to be traders looking past this fear. This takes us to the bull case, the whole hidden gem argument.
Right. They're betting that the market is just overreacting to all that fear. Here's where it gets really interesting.
Let's hear it. What's the rational argument for being optimistic here?
They're basically betting on two main pillars. First, the sheer mathematical gravity of that undervaluation, which we've already covered. And second, the technical oversold status of the stock.
The math is compelling. I mean, buying $10 million for $5 million. If management can just stabilize things, that's an immediate 100% upside.
Yep.
How does the new business model feed into that?
The bulls are wagering that this new trading model in Hong Kong lets the company operate almost like an extremely cheap holding company.
Okay.
If they can just slow the bleeding, if they can get that FCF burn from 4.7 million down to, say, 1 million a quarter, the cash pile becomes a stable foundation again.
So the new business doesn't even need to be a home run right away.
Exactly. It just needs to provide enough revenue to convince the market the cash isn't going to vanish.
It's the classic turnaround gamble. And we've seen that sentiment reflected in the trading action, right? It just hit a 52-week low of $1.06.
Yep. And technically, that low triggers an oversold status on a lot of indicators. It suggests that pretty much everyone who wanted to sell has already sold.
Which leaves the field open for tactical buyers who see that intrinsic cash value.
We saw evidence of that just last Friday. The stock got hammered, but then immediately after hours, it saw this noticeable bounce, right? Moved up to $1.17. That bounce implies that traders are actively buying the dip. They're capitalizing on the panic selling, recognizing that extreme undervaluation relative to the cash. They're betting the fear has just gone too far.
So we have this amazing standoff. Cold, hard math versus hot financial fear. For the traders watching this, what are the critical price points? Where is the line in the sand?
Okay, so we need to define support and resistance. The stock is currently hovering around, what, $1.14, with that little after hours pop to $1.17?
Let's start with the absolute floor, the critical line.
That line has to be the 105 to 106 range. That's the recent 52-week low. And crucially, it's the point where the cash value thesis still holds up.
So if it holds there, the bulls are still in the game.
Yes. It validates the idea that investors are anchoring their valuation to the cash. A decisive break below that suggests the market is pricing in total failure and all bets are off.
And what about the other way? What's the ceiling? If the bulls turn the tide, where are they trying to get to first?
The initial breakout target is probably the 140 to 150 range. That would be the first real psychological hurdle where some profit takers will step in.
And is there a specific technical setup that traders are looking for to confirm a reversal?
They are definitely watching for a double bottom formation confirmed at that 106 level. If the stock hits that support again and then bounces up decisively,
that would be the signal.
That would be the signal. It could turn that cash-backed floor into a springboard for a very rapid move higher.
Fascinating. Okay, we've laid out the math, the opportunity, and the very clear existential risks. So what does this all mean for you, watching this incredible friction between value and fear? What's the final verdict here?
The verdict from the analysis report is pretty clear. INHD is a high-risk speculative play. It's best characterized as a lotto ticket trade, not a traditional investment. Not right now.
A lotto ticket where if you don't scratch it above $1.06, the prize might just be void.
Precisely. Any decision to buy hinges entirely on the belief that the company can actually reduce its disastrous free cash flow burn rate and stabilize that new electronics business.
If they do that.
If they do that, the stock is mathematically undervalued by 50% based on cash alone. That's the huge, explosive potential payoff.
But the caution here is paramount. This isn't just about risk. It's about the timing of a potential insolvency.
Absolutely. We have to reiterate, if that cash burn accelerates or if the new business fails to generate revenue quickly,
If they keep bleeding, $4.7 million a quarter,
then the stock price will inevitably just keep falling to match that shrinking bank balance. The market will just wait it out.
So the bottom line for you listening, keep INHD on a close watch list. Look specifically for it to stabilize above that $1.10 level. If that level holds for a few trading sessions, it signals the fearful selling might be over and the value buying is taking hold. That could fuel a really sharp short squeeze rally.
You know, this whole scenario raises such an important question about market mechanics. Given the clear mathematical undervaluation based on $10 million in cash, a tangible, verified asset.
Yeah.
How long can irrational, fear-driven selling keep a stock trading below its actual cash value? It really makes you reflect on whether markets are truly efficient or if human anxiety can just override financial reality for, extended periods of time.
That's an excellent thought to leave us with, a perfect illustration of how fear can temporarily outweigh clear, hard asset value. Thank you for walking us through this one. It's a fascinating situation.
My pleasure.
We really appreciate you providing us with the analysis report.